Hello, it's Robert Miner with Dynamic Traders Group with this week's DT trading strategies for the week beginning February 1st, where we take just a 5 or 10 minute video to show you one or two potential trade setups coming in the week ahead. We describe it, so we want you to learn from it so you can apply what you learned to any market in any time frame. We do this for our Twitter or YouTube followers, and if you like what you learn, check out my book, High Probability Trading Strategies, and check out our DT reports where you can get a 1 month trial from just $19. And boy, if there's ever a month you might want to keep on top of things day by day with 2 or 3 videos every week and some special big picture reports on the stock indexes coming up, I think this is the month you might want to consider that. Okay, let's get started. I'm first going to take a look at the VXX. It's an ETF, that's a volatility index, and it usually trends the opposite direction as the stock indexes. So it's not something we trade a lot, but it's something that now and then, when there's an ideal kind of setup that looks like it's going to make a pop, as we want to take a look at it. Now, I've looked at this a couple times in recent weeks. We finally got a specific buy signal on I think it was Tuesday, in our DT reports, and when we closed above the close of the prior day, because everything was in place. So there's a lot of other things that came into factors at that period of time to signal that we're probably going to begin at least a short-term bull trend. The reason we look at the VXX is these short-term trends are sometimes 20, 30, 40% change. And sometimes you got to have a bit of a stop on it, so you just adjust your position size so you never have more at risk than is allowed by your trading plan, usually about 3% of your account. So the reason I'm bringing this up now, I realize it's after the fact, unless you took advantage of what we taught you 2 weeks ago, because I featured the VXX at that time and how it was probably reaching a position for a specific trade strategy once it closed above a minor swing high. So anyway, take a look at this. If you happen to be long, always look at the data and say, well, what's a typical kind of trend in this market? Well, going back several months, these pops, so they're big time percentage change-wise, anywhere from a low of about 16% to a high of 56%. But look at the number of days on the upside. That's what I want to bring to your attention. Here is a 56%, or just 5 trading days. This is a long-term trend. 7 trading days. 7 trading days. 4 trading days, almost 27%. So as of Friday, we've been up real strongly, but it's just been 3 trading days. The thing to look at is that more than likely, we've only got another 2 to 3 days on the upside, and potentially only another 1 or 2 days on the upside. Our daily momentum, the fast line's reached overbought, and so that itself would indicate we're probably a day or 2 or 3 from making a top. So it's easy to get real excited that, oh, I got in this trade, I'm up 25 or 30% in 3 or 4 days, but realize that most of these pops are only a few days. So you might want to be trailing your stop pretty close to the market. So what we've recommended, at least, is for half the position on the long side, is you just exit on the next lower daily close, and then we're trailing the stop in the second half of the position, a little bit further from the market, give it a little bit of room in case it does take off, but it would still guarantee us a pretty healthy profit. So remember, look at the markets and see, well, what's the typical trend, both in time and in price? And if you're reaching the kind of extremes near those typical trends, be sure and advance your stop close to the market for at least half your position. You always trade at least 2 units of the position. So here's the weekly data for the VXX also. Just shows a little bit clearer, and the weekly data. And even the weekly momentum, the fast line is getting overbought. So, these are just 1 and 2 week trends. I don't know why this has 7 weeks up here. Let me change that, correct that. There we go. It should be 0 weeks. because this has all happened in the last 3 days. So the whole point being here is probably next week we're going to complete this top unless we're having a much higher time frame decline in the S&P. So that said, why don't we just take a look at the S&P. So this is the SPX Weekly. Just a few things to bring to you. Is number one, this is what we called a weekly foreclose outside week bear reversal. That's a pretty significant reversal. It's the strongest reversal certainly in the S&P for many weeks, actually several months. So what do we mean by foreclosed reversal? Well, you know what an outside week is. It's when the current week trades outside the range, both a new high and a new low from the prior week. And this was an outside the last 2 weeks, but it closed below the close of the past 4 weeks. That's why we call it a foreclosed bear reversal in the weekly data. That's pretty significant. The weekly momentums have made a bear reversal a couple weeks ago, and as we were bringing to the attention of our subscribers the last 2 or 3 weeks, not only did we make the bear reversal a couple weeks ago, is that we're on a bearish divergence between momentum and price. That's a lower a top in the weekly momentum, higher top in price. So that was a warning that we were at or near a top. These are just some very significant geometric levels that also it was riding the last 3 or 4 weeks. And this upper line 39.12 or around a 39.13 was the probable maximum on the upside before it made a weekly high. So we've been in that position actually for 2 or 3 weeks. But last week on this day, well, I think that was Wednesday, it was the first time we actually made the reversal signal going back all the way from the October low. So for 2 or 3 weeks, we've been looking for a probable weekly high, but we've never made that reversal signal. So as I would have in the report, is that the trend is up until we close below such and such, whatever the last minor swing low close was. And so that's what we did Wednesday, and that's called a reversal confirmation signal. It's pretty significant because it indicates, again, it confirms we've made a weekly high. And if we made a weekly high, I'll go back quickly to the weekly, we should be sideways to down the immediate trend for another 2 to 3 weeks. We will have 3 to 5 day corrections on the way down, but another 3 or 4 weeks probably sideways to down with a minimum time target on the downside of March 5th. We should not complete a weekly or corrective decline before the first week in March. It could be far after that, but that would be the minimum. So any lows that we make between now and then will be temporary. Back to the daily. The daily momentum, the 8 reached oversold on Friday. However, if the higher time frame weekly trend is bearish, we should not complete a daily low until the 13 reaches oversold. That would indicate we've got at least another day or two sideways to down before we make a daily low. And where we make that is going to be fairly significant. So number one, eventually we're probably going to reach around 35.81, 35.52. That's just the immediate target. Not necessarily in the next couple, 3 days, but in the next couple, 3 weeks or so, that would be the target on the downside. If I go to the 60-minute data, here's what it's looking like on 60-minute data on the SPX. We're looking at this as a 1 or A low. Nice 5-wave decline, 2 or B correction. That was about the 62% retracement. So here we are as of the end of the day on Friday. We reached the 100% alternate price projection. Now, if our daily momentums were oversold and we had some time factors that indicate we're near a low, that would be a pretty good spot for at least a wave C low. So here's what to look for next week as we wrap this up, is if the S&P continues lower, and ideally if it reaches anywhere around 36.07, that's quite a ways below Friday's low, but if it were to reach that low before it completed what we call a daily low, that would be very significant, telling us that the higher, well, be one confirming the weekly trend had reversed to bear and would also eventually continue net bearish into early March. So that would be very significant if we continued to around 3607 next week before we completed a daily low. So that's some information you ought to be able to use. If you're not short yet, you know, as W.D. Gann said, the safest place to enter a trade is on the first reaction against a new trend. This is just the beginning, probably at least, of a new weekly trend. So if you haven't got short yet, we're already short in our DT Trade Alerts report. But if you're not short yet, well, it's probably kind of a little bit late to get short now because we're near that daily low, but wait for the first reaction that lasts several days. And that's what we keep our subscribers up to date to day by day. So we're going to have lots of opportunities. It's always nice to pick it right near the top and pick it right near the bottom, but don't worry. What's important is we recognize change has been made and some of the minimum targets and time and price for that change, so that then we can formulate a trade strategy on the initial reaction against the new trend. That's it for today. Hopefully you have a fantastic week. Remember, if you're out in public, wear those masks, keep your distance, get your vaccine shot as soon as you can, stay healthy, and so we can get in, enjoy the summertime when that comes around. Take care. Robert Miner, over and out.